Welcome to the Economist Board. I'm John Nelson with M&A, joined by Keith Prather of Armada. How you doing today, Keith?
I'm doing fantastic. Doing fantastic. Yeah.
All right. Well, we are about ready to get into our looks at the industrial sector as well as all the rest of the other sectors. We're going to kick this Economist Board off with a look at industrials. Our models take a look at over 30 economic factors to drill down and give us some really pretty high accuracies that are hitting that 95+% month to month and over several different periods of time. So right now we want to start digging into industrial production. So let's go ahead and hit it. I'm going to go ahead and this is our top level industrial production model. Here we go. And pretty much like you saw last month, it's fairly flat. We have a little bit maybe more improvement than what we were seeing last month, a little bit stronger first quarter into second quarter, but generally telling the same story. Flattens out. Again, you're not talking a real big lift here. I mean, our current index is sitting around 99, almost 100, and we're going to push that index up only up to as high as about 102 for the forecast. So not a lot of big lifts, so fairly flat in the long term. And speaking of the long term, this is what it looks like. And you can still see, although we're not calling for any great big lift, in the long term, it looks really pretty good. It's strong.
Yeah, absolutely. That's what I was going to say is, when we monitor global manufacturing, we look at probably 22 to 23 different countries, and we got a surprise in January. We actually saw global PMIs lift. PMI is a Purchasing Managers Index. It's a monthly survey of manufacturers. And we got the surprise where only 5 countries around the world in January had manufacturing sectors in contraction. So you got kind of this little bit of global acceleration in manufacturing. And there's a couple different things that we're looking at. And this is one of those where honestly, John, we're gonna have to kind of tell folks, you're gonna have to wait until we get maybe another month or two of data because we've got some weird things happening. Number one, we know the global defense sector has really taken off. We got 2 major conflicts around the world, and we know that defense spending and government appropriations for defense spending is starting to surge. So you see sectors like Russia, China, part of the group of companies that are or countries that are kind of rallying around the Russian effort, really seeing expanded production, and then all the NATO countries in the NATO bloc is also seeing advanced production. So you've got that as a backdrop, and we don't know how much that's actually fueling some of the manufacturing activity because when you look at most of Europe, Europe is primarily in recession, and so you don't see a lot of demand there. But then right in the middle of all of this data as well, we've got the Lunar New Year. And so in January, leading up to the Lunar New Year, which was earlier February of this year, it's about a 2-week span where most manufacturing across a lot of Asia is shut down. You see a lot of companies front load orders trying to get production built in January so that they can take delivery and they don't have to wait the 2 weeks after the Lunar New Year to be able to get production back up to speed, get products produced, and then get them shipped, which means they hit sometime in April or May. And so we're trying to figure out, was it just a little bit of a surge because of Lunar New Year? Is it really true manufacturing growth that's stable, et cetera? Now, what the model's showing us is that it might be a little more sustained than like a one-off because of Lunar New Year issue. And, we're going through this one little temporary 30 to 60-day issue. This would suggest that this is a broader, longer recovery. And I would think it ties more to what we've talked about over the last 4 or 5 months, this global inventory glut. So during 21 and 22, even into 23, worldwide, we ordered so many products because of a broken supply chain. We double and triple ordered items. Well, everything delivered, and then inventories surged. We track it with the business inventory to sales ratios, and those were off the charts. And then we went into a global destocking period, and that global destocking period has taken place over the last 18 months. And we're now finally seeing maybe the results of we've gone through destocking, a little bit of improved demand, and then you get a curve that looks like this, where generally it's higher. And I'm only going into a little bit of extra explanation on this one, John, because what this signals to the market is if you're involved in manufacturing, you better get ready, because if this forecast is correct, sometime by the third quarter, you're talking about near multi-decade high output.
Mhm.
And that would mean demand for raw materials, energy, everything you can imagine that goes into feeding that manufacturing supply chain, this industrial supply chain, would surge and take off. It also, for the industrial complex, completely takes recession off the table. No risk at all. So this particular forecast, I just look to see right now, John, you're doing fantastic. I mean, 1 month out, 99.8% accuracy. So if we said it was going to be an index of 101.1, it was 100.9, it's really darn close. 3 months out, 97.3%, and then 6 months out, batting 99.3%. So we've gotten to the point where we're trusting the data. And again, the reason why we monitor the watch monthly is because if this starts to shift and if we start to see a downturn, the model will pick it up and we can give those who are part of the watch and who are members enough warning that they can kind of adjust to it over the next 3 to 6 months. So that's what we've got. It's kind of interesting. I spent more time on this than I needed to, but I think it's important to get all this right up front.
Sure. Hey, well, speaking, part of what your explanation was talk about the demand on the supply chain. So let's take a look then at, what's the impact here going to be if I can hit, there we go. There we go. That's what I was trying to do. And this might be a little bit counterintuitive to a little bit about the argument. It does show the strength right there for the next couple quarters, but then that little bit of a tailing off, which I kind of was not expecting, but it's still the same story we've been seeing for the last couple months. And so then taking a look at it in the long range, putting this all into a better context, it is following along the trend of where this sector has been.
Yeah, absolutely. I mean, we could look at this a couple different ways. I mean, you could look at that spike and say, wow, batten down the hatches, because the next 3 quarters are going to be really interesting from a primary metal demand and raw material demand perspective. But then it kind of falls off a cliff, and we don't exactly know what the model is reading in that back half. But I think a lot of this, John, is going to tie to maybe what happens in the automotive sector. So for those who are subscribing or on trial, when we do the automotive model and you look at it, it's following a similar pattern. And I think that probably feeds a lot of primary metal demand in the US. And so I think that's what it's reading in the back half of this model and the back half of this forecast, is just that drop off. But yeah, watch that initial spike though, because it's basically suggesting the raw material demand and primary metal demand is going to be the strongest since maybe the 2018 era. So showing some rebound.
And of course, then we can take a look at what it would be on the fabricated metal side, which it's almost counterintuitive again. But we've been telling the same story, and this is one of those things where both of these models and the IPMAN models have been running very accurately, and so sometimes they do give us a little bit of a mixed story, and I think this is one of those cases, particularly this one where you could see fabricated metal kind of dipping in the next quarter and not coming back up for a little while. And but long term, this has been one of those sectors that has been taking a beating at different times, dipping and then rising. But right now it's actually looking fairly strong when you compare it with the historical trends, not so much comparing it against the last year or so.
Yeah, and what's interesting, this industry is pushed and pulled absolutely 100% by all the other sectors of industrial production. So we know that there's that really strong relationship, and the question is, which of those industries is the stronger driver, the stronger reducer, if you will, of growth. And automotive is going to really weigh in here a lot. And I know this one and the primary metal forecast are a little more volatile than what we had with the industrial production overall. So these two models, excuse me, we're both dealing with this crud that's going around. So I knew it was going to get me at some point. But the primary metal model that we showed a couple minutes ago, it's batting right around almost 99%, so 98.5% over 1 month. Then it kind of dips down. It's like 93.5%. So there's a little bit of volatility in that 3-month range, but it's 6 months out, it's batting 99.4%. So what we predicted 6 months ago, we're right bang on where we thought we would be. So there's some of that near-term volatility that's kind of taking place, and I don't know how to explain it. Fabricated metals, then, we're running about 98.5%, 1 month out, and then just like primary, it kind of dips down a little bit, kind of 94% over 3 months. And again, we kind of had the UAW strike and some stuff kind of messing around with the data at that kind of in the mid range of this last 6 months. And then coming out of it, then we're like 96.6% 6 months out. So we're still, you and I have always talked about, we love a 95 handle on all of our accuracy. And if we get below that 95 handle, we get nervous, right? And
Yeah.
so we're still long term batting well above 95% accuracy, which is good. But there is more volatility in it relative to maybe some of the other models. And so this one, again, there's not a lot of discussion here other than you really got to go watch those other subsectors, those other models of machinery, automotive, computers, and electrical equipment, and some of those other sectors to really get a feel for what's really pushing and pulling on this. And again, if you're watching this and you're not on a trial, free trial, or not a member, go get one and go check out those subsectors. So
One thing I do want to mention is, as you were discussing about the accuracy of the model, you described earlier how we calculated, this is what we predicted, and this is how close it actually was, and we just peg it to the actual numbers. But the things that could impact it, and why sometimes it seems counterintuitive to sometimes that the 3-month would be not as accurate as the 6-month forecast, but it's those one-off events or those black swan events that will come in that kind of override general market fundamentals. Like you mentioned the UAW strike, for example. All the other factors in the economy were holding strong. And so that causes a dip, takes the forecast away from the model. And then once those things come back, then the actual start to trend right back to where the forecasted model was. And so if you're wondering, well, why are these guys not as accurate in that 3-month period? Well, sometimes the reason is because of those black swan events that just popped up.
absolutely, that's fantastic. Hey, what's interesting, John, you and I have watched this now. We've done these models, we played with them now for 5, 6, 7 years in some cases, right? It seems like forever. And the data's trained over 20, 25 years now, close to on some of them.
Yes.
But the interesting thing to me is that once in a while, it will actually start to pick up a black swan event, right? So when you think about like a war, for instance, like a war in Ukraine, it didn't just start overnight. Someone just didn't suddenly, start going in and start firing, right? It took troop buildup. It took months to get ready for that. And so the models will actually be sensitive enough to start picking up some of that activity, and it almost gives us a little bit of a heads up that something's coming. That's why when we do see a model like that primary metals model that shows good, strong growth, and then all of a sudden it looks like it kind of dives off a cliff, we get really nervous because the model is picking something up specifically that it doesn't like at the tail end of this forecast. And so we are sensitive to it. We just don't know what that event is. And sometimes it could be, like you said, reading what just recently happened with like the UAW strike, where causes dramatic changes in demand. And then, as you just said, the model kind of recovers and comes back to normal. So
Sure.
But you do a great job of, I think, accounting for that. Like in the primary metal one that dropped off, you've gone in and kind of weeded out the impact of the UAW strike on the future forecast, right? So it's not just suddenly rinse, repeat, expecting the same thing to happen next year in the third quarter, right? No. So that's all taken care of. So it's reading something else that we ought to be a little concerned about. So, all right.
And that's why they're a model, and they're not like it's a simulation versus a replication. So
yes, exactly. They're fantastic explanation. Okay. All right, well,
okay.
Yeah.
look, that gives us our top level view on industrial production. So we hope you enjoyed this, and we hope for those who are subscribers, we hope you see you on the sector reports, which are coming up next.
Absolutely. Thanks, everybody. Take care.